Sanjay Sinha, founder Citrus Advisors, joins us live now. Sanjay, morning. Thank you for joining us. Sanjay, a month ago, a level of 5,000 on Nifty was entirely conceivable. What was driving markets a month ago was hope. Now there is despair.
I think that is very correct assessment, Nikunj, because if you see the aftermath of what was presented in the budget, it has caused a fair amount of disappointment in the market. I think in the near past, we've seen three things happening, and these three things are seen to be interlinked. We've seen the confusion related to GAR, we have seen the FII selling, and then we have seen the rupee depreciate. In my opinion, these three issues, at least in the last 1 month, may not have been so interdependent as what rest of the market thinks. But each one of these factors actually has a very profound impact on the market, either in the short term or the medium term. I think GAR confusion, we all know, until the time as we have a resolution on that, we might not have a fairly strong FII outlook towards India. But the selling that we got from the FIIs in the month of April, in my opinion, was fairly muted compared to what the amount of selling that we have seen in equity as an asset class the world over. If you go by the EPFR data, close to about $18 billion worth of equity was sold off in the month of April. In that background, to have got about, say, $200 billion worth of selling in India, in my opinion, is not very large. But the depreciation in rupee, I think, is something that is surely a cause for concern, both in the short term and the medium term, because the factors which are actually behind the rupee depreciation may not be so much FII selling, but the fact that we had last year a trade deficit about $185 billion. And this level of trade deficit with a forex reserve of about $295 billion is surely a cause for concern.
Sanjay, let's start, point by point. Of course, the biggest concern right now, which is the GAR provision. Today, the finance bill is going to be presented in the parliament, which actually entails or encompasses the GAR provision as well. What do you think is going to be the texture on that note?
I think, there is fair amount of expectation that is getting built up around what will be the final outcome on the issue of GAR. I think the two major expectations are that the implementation will get deferred to the 1st of April 2013. And the second thing is that it will be fairly watered down in terms of, not applying it with retrospective effect and only applying it with prospective effect. I think there are a couple of things that we need to keep in our mind. One is that, going by what statements have come from some government officials, even though the issue may be debated in the parliament today and tomorrow, the fine print will actually come out over the next 1 month. So there is not, it's not as if, the entire issue will get resolved between today and tomorrow. Second issue that I have is that the sheer act of the government in terms of presenting the GAR proposal has created a fairly negative environment as far as the investment in India is concerned. Though it has not had a very near-term impact on the FII flows, like I said, that the selling that we got in April may have actually come more from a disenchantment with equity as an asset class globally than from the issue of GAR alone. But I think what it surely has an impact in the short term is a lot of money that comes into the arbitrage segment in India is the FII flows, and that keeps the liquidity flowing in the system. I think that is surely going to suffer because of this proposal.
Right, Sanjay. So yes, GAR is important, but would you agree with my assessment that it will not be a backbreaker? Because globally, all governments currently are running a deficit. US government is talking about getting a buffer tax. European government or European economies are talking about getting a financial transaction tax. So if GAR becomes reality in India, what's wrong in it?
I absolutely agree with you on that, in the sense that there is nothing wrong in the introduction of a GAR provision, where you say that if any entity is transacting in an asset class in India and is not paying tax on that anywhere in the world, there should definitely be a tax implication that should be received by the Indian government. I think as far as that goes, it is fairly fine. I think the entire hue and cry that has surrounded GAR has got to do with the fact that it is being applied with retrospective effect. As long as the GAR provisions are modified and it is made applicable from the prospective effect, I think there is no issue with that.
Sanjay, so in this environment, what would you like to buy? Would you like to buy consumer names, which normally tend to outperform when market conditions are choppy, when global risk on is back, or would you like to buy rate sensitives, where generally speaking they may underperform for this quarter, but if commodity prices corrected and now that interest rate cycle has reversed, they may start outperforming in the second half of this year?
I would put my bets about 50-50% in favor of both, Nikunj, because
50% bet
there is no
means you're
denying the
hedging.
fact.
Sanjay, 50-50 is not allowed. This is a clear hedge. You've got to stick your neck out, give us a proper answer.
Okay, fine. So in that case, if you are an aggressive investor and you are willing to take a contrarian call, then you should put your bets with the interest rate sensitive. But this comes with one caveat, and that caveat is that the government policy should be on the front foot on the positive direction for the interest rate sensitives to perform. Because if you see what is actually happening, we've seen the Reserve Bank of India cut the repo rate by 50 basis points. Have you seen any impact of that on the bond market? I think that itself is telling you a story that, if taken in isolation, a rate cut alone may not be sufficient. It has to be supported with a fair amount of discipline on the part of the government. If you have a huge borrowing program and then you introduce a rate cut, it's not going to have an impact on interest rates at all. So therefore that is equally important. Second is that, we've seen crude prices beginning to moderate over the last week. I think commodity prices do not have a logical reason to be strong in the calendar year 2012, and therefore that should have a salutary impact on inflation. If these two things are there and the government policy is not destructive, then I think there is surely a case for the interest rate sensitive stocks to do much better in 2012 than the defensives.
Okay.
Sanjay, is it too early to start picking bargains? Sanjay?
Not really. Because, like I said, there seems to be a fair amount of expectation surrounding the outcome of GAR, and I think we have probably misread the FII flows. The FII flows in the month of April, like I said, was fairly muted compared to the amount of sell-off that we have seen in equity the world over. In India, of course, the biggest risk that we run today is the policy risk. But, we have seen these phases in the past also, and we've seen the corporate sector actually rebound back. Not only that, if you go and see as to how the markets have behaved every time that there has been a sharp retracement, somewhere around close to these levels, you've seen fair amount of buying coming in from all quarters, whether that be FIIs or even the domestic institutions. So I think the buying at the current levels would surely give us support. And in terms of valuation, the perspective should surely now be a little longer, 12 to 24 months. The valuation surely make a case compelling enough for you to buy.
Besides the pressure points, what do you think is going to hold out in a market environment which is weak, not just domestically, but globally as well? Do you think it is going to be the OMC pack, since the crude prices have been easing off somewhat? And do you think pharma will continue its defensive nature and continue to outperform?
I think surely globally the most important positive trigger that I can see would be the crude prices. We've seen certain amount of softening already beginning to happen. I think the concern that had come about because of the posturing by Iran, that also now seems to be slightly less loud than what was the situation, say, about a month back. So I think that would be the single most important trigger on the positive side. On the negative side, I think the election results in Greece and France definitely do present another case for concern. The euro area concerns, I think, will keep on resurfacing time and again throughout the next 1 year and keep us troubled. But in that background, structurally, if the commodity prices and particularly crude prices, if they keep coming down, I think that should be very positive for the Indian equities.
And what about pharma? Do you think the outperformance is going to continue in a market environment like today's?
I think that's a very strong possibility because, pharma has been a performer over the last 1 year. And these stocks have, they are leveraging both on the fact that the domestic consumption of pharma has been now rising and has become fairly structural in nature. At the same time, they will play actually in your favor on both ways. In a falling market, they'll act as a defensive stock. And in the event that the market bounces back, the valuation gap between them and the rest of the sectors would also continue to be in your favor. And therefore, I think it's a good pack to be in.
Sanjay, let's spend some time and discuss consumption stocks, consumption sectors at length. Where do you mind in the consumption space there is a boom and then there is a bubble?
I think the entire frontline stock in this sector have benefited from two things. One is that they have played out the defensive role over the last 12 months, and therefore they have acquired very rich valuations. At the current prices, we have seen that the quarterly numbers are also extremely strong. The big question is that, do the current prices already factor in these strong performances? In my opinion, they do, and therefore I do not see much of an upside purely supported by valuations here. And I think for that sector to perform a defensive role also has a limit. You cannot keep on buying a defensive sector to an overvalued territory. And I think much of the play in the FMCG sector, I think by now is over as far as price is concerned. They do not necessarily have a case in which they will retrace. But I think for them to repeat the performance of the last 12 months, in the next 12 months is going to be extremely difficult.
Do you worry about auto stocks now? If I look at anecdotal data, which is April sales number, there seems to be a marked slowdown, be it two-wheelers, four-wheelers or CV sales.
See, I have been slightly positive on the auto sector, and there my preference has been the CVs first, the passengers next, the ancillaries after that, and only the two-wheelers come in as the fourth position in terms of the choice of subsectors within auto. That is the position I even now continue to hold, because as we discussed a short while back, I believe that the year will belong more to the interest rate sensitive, and in that case, if the infra pack begins to perform, you cannot have the CV sector being not being a participant in that rally. So that's where the first preference comes. Passenger cars, I think, have been an enduring performer all the while, and I don't see that declining. In fact, if the interest rates become softer and the consumption story for rest of the economy is going to be intact, you will also have the passenger cars getting benefited. And the ancillaries, I think, are at very attractive valuations.